For decades, there's been this epic battle raging for the very soul of investing. On one side, you've got the cold, hard logic of mathematics, promising a perfect formula for success. And on the other, the messy, unpredictable, and, let's be honest, often irrational world of human psychology. This is the story of that fight.
So, what's the deal? Is investing a science? Or is it an art? Is the market some kind of machine that we can solve if we just find the right equation? Or is it more like a canvas driven by human emotion, fear, and greed? Let's try to unravel this.
All right, let's rewind a bit. Our story really kicks off in the mid 20th century. Economists, full of that post war optimism, truly believed they could tame the wild, chaotic nature of the stock market. They were on a quest to turn finance into a pure, predictable science. And, the first big breakthrough? It came from this young academic named Harry Markowitz. He wasn't even trying to pick the next hot stock. Nope. He was focused on a much bigger problem. How do you even begin to manage the risk of it all? His answer was this totally groundbreaking idea called modern portfolio theory, or MPT for short. And the core idea, it's actually beautiful in its simplicity. The overall risk of a whole group of stocks is actually less than the risk of any one stock inside it. Look, we've all heard that old saying, right? Don't put all your eggs in one basket. Well, what Markowitz did was take that bit of folk wisdom and strap a rocket to it with some serious math. He proved that diversification isn't just a hunch, it's a quantifiable, risk-reducing powerhouse. And you can actually see how this works. I mean, look at this. As you add more and more stocks to a portfolio, that company-specific risk, what they call unsystematic risk, it just kind of melts away. But notice how that line flattens out? You can't get rid of everything. There's always some systematic risk left over. That's the risk of the whole market going up or down. Okay, so this whole line of thinking led to one of the most famous ideas in all of finance, the efficient frontier. You could kind of think of it as the Goldilocks curve of investing. It shows you the absolute best return you can possibly expect for any amount of risk you're willing to take. The theory says any rational person would only pick a portfolio that's right there on that curve. So Markowitz basically laid the foundation. But pretty soon, other brilliant minds came along and started adding more and more gears of pure logic to this perfect, rational investing machine. All right, next up, we have the efficient market hypothesis, or EMH. And wow, this one is a doozy. It argues that a stock's price already reflects every single piece of public information out there. So what does that mean? It means trying to find some hidden gem, some undervalued stock, is basically pointless. You can't beat the market because the market already knows everything you know and then some. And then you've got CAPM, the capital asset pricing model. This gave investors an actual formula. It says you can figure out the return you should expect from any stock. All you need to know is the risk-free rate, the market's expected return, and the stock's beta, which is really just a fancy way of saying how volatile it is compared to the rest of the market. So here's the thing. MPT, EMH, and CAPM, they all click together like a perfect puzzle. They created this beautiful theoretical machine, an entire way of looking at investing that was built on the idea that markets were perfectly efficient and investors were perfectly rational. But there was a problem, a huge one. There was a ghost in the machine. In the real world, this perfect machine, well, it didn't always run so smoothly. I mean, think about it. If markets are so perfectly rational and prices always reflect the true value, then how on earth do you explain stuff like the dot-com bubble or the 2008 financial crisis? Why do prices sometimes go completely bananas only to come crashing back down to earth? These perfect theories, they kind of struggled to answer that. And it turns out that ghost in the machine, it wasn't a ghost at all. It was us. It was humans. Our messy, irrational, emotional, and beautifully flawed minds were totally breaking these perfect financial models. And this realization gave birth to a whole new field of study. Enter behavioral finance. It's this whole field that smashes psychology and economics together to figure out how we actually make financial decisions, not how the perfect models say we should. It accepts that we use mental shortcuts, gut feelings, and emotions, which a lot of the time leads us down the wrong path. Let's just fly through a few of these mental glitches, okay? First up, loss aversion. This one's huge. Psychologically, losing $100 hurts way more than finding $100 feels good. In fact, some really groundbreaking research found that the sting of a loss is felt, get this, 2.25 times more intensely than the joy of an equal gain. And what does that mean for your money? It means we hang on to our losing stocks for way too long just to avoid that pain of admitting we messed up, all while that money could be doing something useful somewhere else. Then you've got herding. Come on, we're social animals, right? We feel safer in a crowd. And in investing, that makes us all pile into the same hot stocks, creating those exact same speculative bubbles that the rational models just can't explain. And you know what that means? You might be the last one to buy in right before it all pops. And how about anchoring? This is where we get totally stuck on one piece of information, like the price we first paid for a stock. We start judging its value today based on that old anchor, which can stop us from selling a loser or even buying more of a winner, all because of a number that is now totally, completely irrelevant. Oh, and the list just keeps going. You've got overconfidence, thinking we're smarter than the market, representativeness, seeing patterns where there are none, the gambler's fallacy, thinking a coin is due for heads. Every single one of these is a little mental trap that can do some serious damage to your portfolio. So where does all this leave us? Is the machine just broken? Well, not exactly. Today's investment playbook doesn't just toss out all the math. Instead, it creates this really powerful mix. It's where the scientist finally shakes hands with the psychologist. And this whole tension, it gives us the two main philosophies in investing today. On one side, you have the scientists, right? The passive management folks. They basically accept the efficient market hypothesis and just try to match the market by tracking an index. But on the other side, you've got the psychologists, the active management crowd. They believe all these human biases create little glitches in the market, glitches they can exploit to try and win. But you know what? The really smart strategies today, they don't pick a side. They blend both. You see stuff like a core satellite approach, which uses a big, stable, passive core with some smaller, active bets around the edges. Or ESG investing, which brings human values into the cold, hard math. And even smart beta, which tries to build indexes that are, well, a little bit smarter by capturing some of those market quirks. And that brings us right back to the beginning, doesn't it? Investing, it's not just science, and it's not just art. It's a dance between the two. The real trick is knowing when to trust the cold, hard numbers, and when to remember that it's all being driven by very human minds. So it makes you think about your own approach, right? Who's running the show with your money? The scientist or the psychologist?